Welcome to the weekly markets update. I'm Marit Sagarishvili, investment consultant at Kamak Retirement Group. Today we're recapping what moved the markets in the last week of July. The markets were volatile this week in the face of the earnings reports and continued global spread of COVID-19. The failure of Congress to come up with an agreement on the next stimulus bill also weighed on the markets. But better than expected results from the largest technology companies late in the week lifted the market off its lows. S&P 500 ended the week with a 1.75% gain. Earnings from the big technology companies such as Apple, Facebook, Alphabet, and Microsoft came in better than expected this week. In combination, the companies saw their market cap increase by additional $250 billion. Currently, those companies have a combined market cap about $5 trillion, which is approximately 1/5 of the entire S&P 500's total market cap. The amount of negative yielding debt has been steadily climbing since mid-March. There are now 15 trillion worth bonds trading with yields below zero, just shy of the 17 trillion peak last year. The latest move comes after central banks doubled down on their ultra-accommodative policies after pandemic started sweeping across the globe. It's not just the government bonds that have been impacted. Some corporate bonds are trading with sub-zero yields as well. Fed officials remain dovish as the Fed policymakers left interest rates near zero at their policy meeting this week, also pledging to maintain the support for the economy as it recovers its worst downturn in over 70 years. Gold prices soar. Gold futures surged to another all-time high of $2,000 per ounce this week, beating its previous record of September 2011. However, it's not just the gold. Silver prices are soaring as well. This is not surprising as investors tend to view gold and other precious metals as a safe haven investment during times of crisis. US dollar is heading for its worst monthly performance in almost a decade. Currently, dollar is depreciating against the global currencies as the continued spread of COVID-19 in US ignites fears that US economic recovery will stall. Contributing to the decline is the prospect of mounting US deficit and a prolonged low interest rate environment. US economic growth plummeted to negative 32.9% on an annualized basis in the second quarter, the largest decline on record dating back to 1940s. While the growth is expected to pick up in the third quarter as the economy reopens, some economists are questioning how sustainable the rebound will be, given the recent surge in coronavirus cases. The number of Americans filed for unemployment benefits rose additional 1.4 million this week. Continuing claims, which measures those currently receiving benefits, rose more than expected to 17 million. The worsening job numbers can be attributed to many states and businesses having to roll back their reopening plans due to resurgence of coronavirus cases. Consumer confidence declined by more than expected in July. It appears that recent flare-up of COVID-19 cases is weighing on the sentiment again, as many Americans worry the resurgence will threaten the economic recovery. Energy companies report lower earnings. ExxonMobil and Chevron posted the worst losses in decades as the pandemic contributed to a global supply glut and demand severely declined. Energy is currently the worst performing sector in S&P 500 index this year. Thank you so much for watching. For questions, please visit our website, kamakretirement.com.